You know, we all try to predict the future, what the future may hold. Most importantly, it would be great to know the future when it comes to stocks. Over the years, we have developed a strategy called FPCMC, which means Future Potential Comparative Market Cap. In its infancy, back in the late 80s, we called it basically finding undervalued stock, which is very hard to do because you can only find undervalued stock based on usually a turnaround candidate or perhaps on a stock that is new and that has a potential because of expansion. So over the decades, we developed this strategy and tested it throughout the 2000s, like 2006 already, especially with, for instance, Baidu, and then later on with Netflix, Amazon, and Facebook, and different stocks, and including Tesla in 2013. And that method, the FPCMC, which is Future Potential Comparative Market Cap, is a very precise forecasting model. And of course, we know nobody knows the future, it's just a probability. But the probability is so high that it's almost a certainty, which of course it isn't. But I'll explain in a second how it works. In 1990, I moved to the US for one reason. In Europe, it was very hard to purchase American stocks. And I was more into trading than in investing. But I found one stock, I discovered it, it's called Dell Computer at that time. And so I moved to the US, and within 8 years, that stock, I believed in that stock, because the revolution of PCs was just upon us, and I believed that that stock would go up. And it did go up. Within 8 years, it went up 100,000%, meaning each $1,000 invested became $1 million. And that's in essence where we discovered or started to develop the FPCMC model, which is to find stocks, especially younger companies, that have huge growth potential, not just regionally, but globally. With the arrival of the internet, of course, it became much more interesting. Of course, you had to believe in the internet, like when Amazon.com came on the scene and it started in the late 1995. You had to believe that the internet, if you knew what it was, would capture the world, that people buy stuff online, and that you can go literally global. And of course, we saw that in the years later, at the end of the 90s, and then in the beginning of the new millennium. And there we have one example after the other, be it AOL, which I never understood what it was, basically, or why people like it. But anyway, it's a growth company, and it spread. And then we had the arrival of Google. And then we had the arrival of other companies we don't even know anymore, Netscape, long forgotten, you know. But in the recent years, of course, there's many companies, again, that we know and recognize, like Netflix, for instance. In 2012, in August of 2012, we produced 5 videos where we recommended 5 companies, or where we saw growth potential in 5 companies. And those companies were eBay, they were Amazon.com, specifically Facebook, after it had the IPO and tanked from 40 down to below 20. And then that was in August 18 or 19, some around that time. And then we also had Google via YouTube, because there's the huge potential of monetization. And the largest performance from all those stocks was in Netflix. And a few weeks later, also we learned that Carl Icahn went into Netflix, and that stock at that time was around $63, and we know before the split, or before adjusting for the split, it basically went up to over $1,000 if you, or around $1,000 if you take it. And that is quite interesting. But here we see how we analyze those stocks specifically, and we analyzed other stocks before, especially in 2009 when we had the financial crisis, the total collapse in March of 2009. It was unreasonable that companies would go under on the one hand. Either you believe that everybody is going bankrupt and everybody and the economy itself, the world economy, would be over and we go back to the Stone Age, or you believe that there's potential with the home builders from Hovnanian, you know, Ryland Homes and so forth. or Visa Homes even. They were really on the brink of bankruptcy, or Pier 1 imports, retailers. I never liked retailers so much, but Pier 1 was down to 10 cents, and within a certain period of time, a couple of years or so, it was above $10 again, and $20. We didn't see that in particular with Pier 1 because we didn't concentrate on that or didn't focus on that. We were focused on the home builders, the financials, and so forth. And so there were huge opportunities in real estate. Back then in 2012, also the first leveraged ETF on real estate on the REITs came out, the DRN. And so you can analyze the future potential comparative market cap in individual stocks, and therefore you can see also an economic trend. You can also basically predict an economic trend, especially if it's on the bottom. Either everything is over or we continue as a society with capitalism and we grow. And so we saw growth back then. And then our model became very, very attractive. Even though Baidu was already doing great and some other stocks, and before that, like we had the resort stocks like Wynn, Las Vegas Sands, when they came public, and they had the rallies throughout till October, end of October 2007. And then everything collapsed in 2008 till 2009. For instance, Las Vegas Sands in October 2007 at the end was at almost $150 and collapsed to below $1.50 in the spring of 2009. So a 99% erasure. But then again, you have potential. You either thought the companies go belly up, or you think that they will continue, they will find ways to finance and get new debt loads to continue, and their business is either good or is bad, whatever you think. But that's the basis of analyzing. What is the future potential of a company? It could be positive or it could be negative. Of course, our focus is on the positive, because going short, you can only make so much money. But going long, and if a stock has 1,000%, 10,000%, 100,000% potential over the years, then you can, of course, calculate your capital gain, your possible capital gain, which is far, far greater than short, because in short you have to borrow and so forth, but we're not going to go in there. But the future potential comparative market cap is a quite interesting strategy and model and how it works. And also in 2002, we analyzed Apple Computer. The same thing. Will it go under, or will it go ahead and expand? And with all those things, of course, we couldn't see an iPhone back then or things like that. It all has developed over the time. But if you believe that the company will survive, obviously that company has to increase their market cap, which means it should result in a stock price appreciation. Of course, there's often dilution for various reasons, but in general, the key is the market cap, that this one will increase. And then you compare to established companies that are successful or that have a certain market cap, and I explain. So, for instance, we had the Baidu story. That's a quite interesting analysis, because you take Google. Google, of course, has the search engines, and it's all around the world. And now Baidu is in China. So Baidu has the Chinese market because Google can't enter, or was then forbidden or kept out. So Baidu, of course, in a market with 1.3 billion people, is a huge market. In the US, you have 300 million plus people, and then you got the world total with 7 billion people. But let's stay at the basis. In order to reach 1.3 billion people, you have to be in a lot of countries, so to speak. So anyway, but the key was, of course, China wasn't developed, was only developed for 300 million people. So it's a comparison to the US. Now you have a market cap that's hundreds of billions of dollars already in Google, and then you got little Baidu, which back then wasn't even $10 billion market cap or less. And of course you had China, not so much transparency and so forth. But just so that you see the picture, here's Google, and that's a comparative market cap of future potential comparative market cap. Of course, you cannot take the whole Google market cap. You calculate what the potential would be for a Baidu based on, for instance, eyes on that particular search engine or whatever Baidu does. Of course, all has to be taken into consideration, the management, the financing, and everything that's done. But we know the growth rate in China was much, much higher than here in the US, of course. You were double digits at that time, and everybody's getting on the internet also through the cell phones, through the apps and so forth, and they need search engines. And then depending what the company does, what they add, and actually the ad market, the marketing, where they monetize their users, and the key is users and so forth. But I think you get the picture. You got Google with a huge market cap, hundreds of billions of dollars, and then you got a little Baidu, which has only a little share of the global market, but is still potentially very, very big. But it's not worth 5 billion or 10 billion. It's worth 50, 60, 100 billion at least. So you see the 1,000% potential, or 800 to 1,000% potential of increased market cap, not tomorrow, but over the years. And the same is true with other companies. So in early May 2013, for instance, we looked at Tesla, Tesla Motors. So you can look at it as a car company, which we didn't. We said, okay, they make cars, but because there's no parts, moving parts like in a regular gas engine car or whatever, it's an electric car. It's like a little toy car, which is made big, and it hasn't that many moving parts. You have the drivetrain, and then you have the battery, and then you have, quote unquote, the body on it and the chassis. So yeah, you're looking at it as a car company, then you don't see the bigger picture. And FPCMC is based on seeing the bigger picture. So what does Tesla have? It's a tech company. You have a PC basically in there, a full screen. Why would you ever think that this is just a regular car company? Then you have a completely different drive system. You don't have a gasoline engine like many of the competitors had. They have an electric feature of a car, but they're not electric cars. And the ones that were electric cars, they didn't even move and they looked ugly. So Tesla has a very good design. And the first Tesla, the Roadster, we almost disregarded the company, with the Lotus Elise body. And I guess Elon Musk will tell you too, that's not, that wasn't the right thing. But, it's a startup, it's an attempt to make something new and to have a breakthrough, and you want to be efficient. And so you take what you can with the money that you have. But once Tesla had the ability to have more money, they had a super design, the Model S, and the moment the Model S came out, or was announced, that's a winner. You have to have the bigger picture, and you have to be in the loop of things. But if you think about it, and then when the supercharger stations came, the network all across America, all around the world, and it's expanding and expanding, and you can freely charge your car, and then with all the other components to it. And then you see that other companies want also their drive system, their technology, and different things. And Tesla is the standard for electric cars. Who else made an electric car that's going 0 to 60 in 3 seconds or less, or just a little over that? Hardly anybody, at that point of time. Today we know Faraday Future is here, and other companies that want to attempt that, and that will probably achieve that. And but just saying, this is the bigger picture. It's not a car company necessarily. So how do you do the FPCMC model in that? You take Apple Computer, which is a purely tech company with hundreds of billions in market cap. At that time, 250 billion. You go to 500 billion with Apple Computer. Now you take Tesla, which at that time was not even, I think it wasn't even around 7 billion market cap. So a regular car company is 50 billion or whatever, So if it's successful, you're already at 50 billion, so you already have your potential of maybe 500-700% over the years. Now, if you go tech company, how much is Tesla really worth? And then you do the calculations, the different ones. Apple is not going to stop. Apple is coming out with more iPhones, with this thing and that thing, and whatever ideas they have. And they also had $100 billion in cash. But so you think, so Apple is a cash machine. So if they had 500 billion or 600 billion, Tesla could be potentially over the course of the years, if they execute, and I trust Elon Musk will execute, and we trusted that he would, and he's a genius. So obviously we think that the company is not worth 7 billion or 10 billion or 50 billion, but we think based on different calculations and comparisons and all those things on potential that it's worth 250 billion in market cap. not tomorrow, but over the next coming years. And 250 billion market cap in the next few years will not be such a big deal. We just heard Amazon.com going through the roof in their market cap, and all it is an online retailer with a small percentage of consumers yet buying online. So we know Amazon.com will expand like crazy and will increase in market cap, but of course not maybe 1,000% in Amazon, but in 2012, in August when we did the video, Amazon had still a huge potential to increase quite a bit, even though they were already high. But now Tesla, back to Tesla, now they're buying Solar City, and there's a strategy behind that too, to not only monetize their users with the cars and bringing out the Model 3 and having now the Model X, but also the solar implementation, which is the future of energy. You know, wind is ugly, it's a lot of work out there, it's one source, it's clean energy, whatever, but you know, you have those windmills everywhere through the landscape, and wind hasn't yet been proven. But sun is the old energy source, the real original one. You can use the sun, and with today's solar technology, you don't lose much from the sun collector or the solar collector to implementation, you know, and all those things. And that's why for a season first, solar had such huge potential as they innovated the solar industry compared to other solar people who still work with the silicon stuff on their panels, and they use the film, you know. So that's a different story. But just saying that Tesla has to be looked at it at a big picture. Tesla Motors, you know, it's just an example. It's not saying we need to buy this stock or whatever. That's not what we do. We're just saying that was our potential, and that's how we looked at it. It's a future potential comparative market cap. The comparison was to Apple, for instance, but not to their full market cap, but only a certain percentage of it, if things work out a certain way. Now, there's always black swan events. And black swan events, they can be Brexit or whatever, you know, whatever happens, you know, and there we can calculate the impact of a black swan event. To some extent, you know, but we don't know all the things. There's stocks that have been hyped up based on nothing. You know, GoPro was one of them, a little video camera which everybody can copy in a similar way, and the market cap goes outrageous. You know, there's a hype factor. So that's not really a monopoly, quote unquote, or something that you could think cannot be attained by somebody else. Amazon.com had many competitors, but they have proven that Amazon.com is innovative, and they're here to stay for a long time, we think. But we know on the example of Kmart and Walmart, Kmart was there a long time ago, or JCPenney or whatever, and Walmart came along much, much later with Sam Walton. And today, Walmart is the largest retailer in the world. You know, but even Walmart has a hard time to compete with Amazon.com, or can't even compete online with Amazon.com, so that's a brick and mortar retailer. But nothing is here to stay forever, but there's a certain potential. So Walmart in the late 60s, so whenever they went on public, they had a huge potential compared to a Kmart, compared to a Sears, and so forth. But I wasn't around back then, so I was too young. So that would have been also, again, an FPCMC model, where you see the future potential comparative market cap to a competitor who is larger, provided that the new guy or the new kid on the block is capable of coming close or competing with the other larger guys. And we saw many examples like this in the world. We saw Richard Branson with Virgin Airlines, who Boeing didn't even lease a plane to them, you know. So they started with one plane, and today it's a superior airline with many of the newest planes in the world, and so forth. You know, I'm just saying there's so many different stories and examples. Then we also had Facebook. You know, if the stock was only available in the second market until 2012, it went public. It was at about $40 or above that, which was a little bit hyped up. And you still would have made money if you waited the downturn to more than 50, 60% down, because it went to around 18 or so in the summer of 2012 after the IPO. But it's a no-brainer. You know, you got 600 million users. The world has 7 billion people. Okay, you know, maybe only 3 billion have access to the internet, or maybe 4 billion now, and about 1.8 billion have a phone, cell phone, which means they can also access Facebook. So it's a no-brainer. Meaning 600 million will grow eventually to 1 billion and probably to 2 billion people. So you're creating a huge community, and here the potential is, first of all, the value of the users. How much is a user valued? And you're talking about advertising dollars for each user, the power in advertising and marketing, but the other thing is also the connection of those users, monetizing them in different other ways. And we see it step by step. It doesn't happen overnight, it takes some time. But a genius idea, a simple idea basically. Facebook started on university campuses on one and then on more, and now all around the world, and you connect with Facebook on virtually every app, or on the internet you log in with Facebook instead of creating your own password and so forth. You just, of course it's now 2016, so it's 4 years later after 2012, and it's a long time after the company was started, but still you had to have the vision as early as possible to see where a stock could go, the future potential comparative market cap to a competitor or something else in that category. And that's, we've seen that standard, or this kind of model, has been very accurate. And now the newest phase of that is the turnaround possibility, which is a little bit different. As we mentioned before, turnaround stories are different stories. You have to have really good research. You have to really see the macro picture, the really big picture of things. Is a company going bankrupt, or will a company really turn around based on management, on capital provisions, and all those things, the micro market, how they got into that position that the market cap is so low, and what's the situation, and so forth. So that's a little even bit more difficult than a startup or a company that's expanding like crazy. But anyway, that's also a way to implement this FPCMC model to see for turnaround candidates. A little harder, but this year in 2016 we had in early February calls, late January, early February calls for Cliffs Natural Resources, for Freeport-McMoRan and Chesapeake Energy, and so on. And the model even went so far, even though we cannot say market cap in this way, the future potential comparative market cap, but the essence of the model is going for gold, for oil. So it's a forecasting model for certain trends and macro economies, and comparison to other things. Oil is dirt cheap at 20. When it was 30, it's dirt cheap, and it usually turns in February and in July, depending. And so we were able to forecast it exactly for February 2016 that it will go up, and it did more than double. So about double, because it went down to 26 barrel and went up to almost 50, 49, 48. So the next thing was gold. Gold was low, even though gold has a long cycle, 10 years, 15, 20 years, depending, but it's getting shorter. And so on gold, we saw coming down so much and turning. And so you can see based on a turn. So that's a turnaround story on one hand. But in gold, we had the nugget, a triple leverage bullish ETF by Direxion. And that one went up over 700% in just 6 months. So that's how the market is played. But if you think gold goes up, then you act accordingly. So we're just saying that's a possibility, just like we said the leveraged ETF in the real estate market at that time in 2012, the DRN, was excellent, a bullish ETF leveraged on that. And now the nugget, for instance, on the gold, and on silver it would be the HGQ, but we don't feel as much comfortable with that one. But it all has to do with variances. So stocks, in a sense, are safer than the ETFs, but because ETF you can read the market basically, in a sense, but the leveraged ETFs operate in a different way than for instance, it's simply to have a stock, to find a startup early, or a turnaround candidate early, or to find a company that's exponentially expanding like crazy, and you could have applied it to Twitter, to LinkedIn, whatever is now very well known and popular. We didn't focus on those, but other than considering it. But so what we have is simply to discover stocks that have huge global growth potential and then compare it to leading companies and even secondary companies, and then calculate a potential market cap over the years if things work out. Of course, you monitor because things may not work out. But right now, we, for instance, in technology, we have MAUs, monthly active users, and the value of each user, either monetized or not monetized. But we saw the first example in WhatsApp, and that again confirmed our model. For instance, with WhatsApp, which was sold for almost $20 billion, with 400 million users at that time to Facebook. So Facebook already applied that potential, how they could use it and how they can monetize it. And today, WhatsApp has more than double its users. So comparing what it costs to get those users, the acquisition cost is minimal today in comparison. But back then, everybody said, was shaking their heads and said, "What's going on?" So this is the thing that we have, is finding companies that have huge potential, but not hype, but companies that have really adding growth, that have growth, that are adding users, that are adding clients, that are expanding, and that have almost unlimited potential. So that's the interesting part on our model, and that's we just wanted to explain the basics of it, the rough draft, the network, the skeleton of it, so that you know what we're talking about, how we can literally, in a sense, predict with high probability where a stock price is heading. And that's how you can see how a stock can definitely not only increase a little bit or something, it can multiply. There might be phases where they don't do much, but it's all based on growth and the way to find them as early as possible with a viable service or product. And thank you so much. Until next time.